Hey guys, welcome back to another week of the Educated Homebuyer Live, where Josh and I answer your mortgage and real estate questions to help you become the educated homebuyer. So Josh, got a little bit of news since last week that has impacted our housing industry in one way or another. Today we had the Fed meet, which we're going to talk about today with some different charts, kind of what Powell went over. We also had the National Association of Realtors come out last Friday and change or at least settle, if you will, and impact how buyers agents are going to get paid going forward, which essentially is the premise behind the title of the show. Don't wait, the cost of buying a home is going up, but I think it should say are going up. Either way, we're here.
One of those two will be correct.
It doesn't matter. Welcome back. Josh, how are you?
We're having a very enjoyable week, Jeb, with lots of, again, as you said, Fed news, data, the NAR lawsuit settlement, which is not final, but that has not stopped any media outlet or person with a Twitter account or YouTube video from telling you exactly what it means. So we decided that we also needed to share our thoughts on it. So you'll have that next Tuesday.
Yeah. So a couple weeks ago, we recorded an episode on the podcast about the initial idea of, the change in buyer compensation, whatever. This was before NAR settled. We didn't know NAR was going to settle, and we didn't know the impact that it was going to have on buyers' compensation at that time. We now have a really good idea of what that means. We recorded an entire episode today on the educated home buyer, basically coming at it from the buyer perspective. Everybody right now is talking about how it's going to affect agents. Okay, I need to know that, but you don't care about that. You don't care about me as the agent. You care about you as a consumer, how it's going to affect you. So next Tuesday, that is going to drop, and it's going to be a really informative episode that you're going to want to pay attention to, because it is going to affect you if you are buying a home in one way or another. That said, this past Tuesday, we talked about FHA versus VA versus USDA versus conventional. We went over everything in there. If you didn't check out that episode, you should do so on the Educated Homebuyer podcast on YouTube and or wherever you get your podcast. So Josh, we always like to welcome everybody that's listening by starting with some slides. So every single week we update slides. There will be a link to these slides in the description wherever you're watching it, so that you can follow along if you'd like to see any of the information that we're talking about. But with that, we always like to start by looking at inventory, because inventory is what drives market supply and demand. So this past week, 507,000 single-family homes on the market in the U.S. That is 1.3% more than we saw last week and 22% more than a year ago. But here's the kicker. It's 105% more than just 2 years ago, Josh. And I don't know if you remember this, but 2 years ago is when we saw the last of those 3% interest rates. That's when the Fed started to hike 11 consecutive times. Was that what it was? Starting back in March of 2022. So
we have a fancy chart in here that actually shows you exactly when those rates crossed the Rubicon to the horrific rates.
There you go. And we're going to take a look at that. But here in Orange County, sitting at 2,007 homes. Last week, we were at 1,999. So we increased 8. What is that on a percentage basis? Small, very insignificant, if you will. Huntington Beach at 138. Last week, we were at 132. Again, insignificant moves on those fronts. Nationwide up, a little bit, but we're still dealing with the same problem, which is essentially a lack of inventory. This chart just shows, again, kind of a breakdown of where we were last week, the same time, versus where we are now on the numbers, going from just over 500,000 homes to just over 507,000 homes. Shows you where our peak was, where our trough was with regards to inventory, but more importantly, where we were back in 2015. Josh, I can't read that number from here. What does that say?
2015,
what was that number?
639. Active listings for the week. This week in 2015 were 982,639. So almost a million, but we were already in 2015 under a million, and we really need to be over a million.
Yeah, we do. And it's almost 100% more than we have today, which is really important. Josh, you threw this in here, and I have, you changed the order. But
they got out of the direction. Fine. No. My apologies. It went into the wrong place. So we will not discuss this now.
We'll come back on that one.
We'll come back.
So new listings. So new listings this week, 59,000 new listings added to the inventory, with another 16,000 immediate sales, which basically means 16,000 of them went into escrow immediately. So total new sellers were 24% more than in 2023. But what's important to note, you see the gray lines on this chart showing previous years with 70 to 80,000 new listings in mid-March. So we still have a long ways to go with regards to selling or new listings coming to the market to get back to some more normal activity. This shows median home price. Median home price is now just over $435,000. Large part of that, mortgage rate's been rising, price appreciation. It's been a little bit slower than expected, so only 1.2% over the same time last year. What else do the notes say? I'm looking at Mike Simonson's notes from Altos because it just gives a pretty good breakdown there. But you can see both of those numbers are increasing. Median price of homes under contract, 345,000 single-family homes in contract right now, with 66,000 new contracts starting this week. That's 15% more than a year ago. The price of new homes in contract is $389. That's unchanged from a week ago, but 4% above where we were this time last year. And then price reductions, right? Price reductions continuing to tick up a little bit, now sitting just under 31% at 30.9%. And as we always talk about, that's 40 basis points higher than we were last week, but it's normal in any market traditionally to have somewhere between 30 and 33% of homes on the market having some sort of price cut. So this is not something that you should really be concerned with at the moment. Rising rates obviously play an impact on that. If you see rates come down, you're also going to see both inventory probably change a little bit, and you're going to see price reductions probably change a little bit, just because less sellers are going to have to reduce their prices in order to get things sold. Now, Josh, I want to go back up to this chart just because it's here, and we could talk about the Fed's language, right? So one thing that happened this week, or today rather, is that the Fed did come out, kept rates the same. Really, really important is that they still said that they're expecting 3 rate cuts this year, but this is the change in the language. So what are we looking at here?
So it was funny. Before the Fed meeting, as they were getting ready for it, I had that up on CNBC and was preparing my slides. And you're going to see almost all of these slides are just a big deep dive on jobs. We talk about the Fed's dual mandate is price stability, which is they define as inflation at or below 2%, and full employment, which full employment also a moving target, 3.9% where we're at right now. Basically considered full employment, but the trend is going in the wrong direction. We're up 0.5% over the last 6 or 8 months. So I wanted to jump in, but the things I wanted to point out here was the only thing that changed in their statement from the last Fed meeting is they changed from job gains have moderated since early last year, but remain strong, to job gains have remained strong. So they took away that piece about moderating, but we're going to see jobs are actually doing more than moderating. And it's going to go a long ways toward telling us what happens next. Let's actually circle back to those 3 there, Jeb. Non-farm payrolls, this is what we look at. So you can see a lot of noise there. They've jumped around, but if you look at that dash line and look at that 1-year moving average, obviously coming down. So do we have job losses? No, we are still creating jobs. We are just not creating them at the rate that we need to for a population and economy of our size. Look at employment. So employment continues going up. So we just looked at that last chart. Jobs are growing. We're getting more jobs. We're just getting them at a slower rate. And as a result, you're looking at this where they're growing, and the divergence between the red line and the gray line are something that we've been talking about. At the last many 5, 6, 7, 8 Fed meetings or NFP announcements, we see this number where the establishment survey says, hey, a ton of jobs were created. And then we look at the household survey, and that's the gray line, and you're seeing far less jobs created. The household survey doesn't have the big adjustment for birth-death ratio, and that doesn't mean people being born and dying. That means new businesses coming into existence. And when you have an inflection point, it is known that the NFP data overstates that. So what we are seeing is month after month, these big revisions. You saw Jeb in January. So in February, we had a huge number of jobs created in January. Well, the March report comes out and we had a big number. And what do? They go back and they bring that number down from the previous month. And I could not find that slide, but that is one of the surest predictors of recession. So we've been talking for going on 2 years now that we have the yield curve inversion, which is a pretty safe predictor of recession. When you see an inflection point to the downside where we are getting revision after revision after revision and large revisions, those always pile up right before you see those bars on the graph where we head into recession. This is the JOLTS data. So we talk about job openings. We're above that blue line. We have more job openings than what the Fed likes to see. It shows too much slack in the labor market, meaning not enough employees for too many jobs for them to pick from. Employers can't fill jobs and they have to pay more, which is inflationary. But we're seeing a big downtrend and we are now below that linear trend from 2010 to 2019, but still above that blue line there, which is what the Fed would like to see. So again, what they were talking about today, there wasn't a whole lot of conversation, Jeb, about inflation. Inflation, as we know, the last few months have shown to be hotter than what we wanted. If you're projecting out forward, even with some good months, we're probably going to be best case 2.5 at the end of the year, when people were hoping, expecting that by mid-year we're going to be at 2%. And that was when they were expecting 6 and 7 cuts this year. So when we look at this, employment growth is almost back to zero when you look at the number of in-persons employed. This is another measure that tells you the strength of the employment market. Full-time employment since middle of last year has been going down. We get these jobs reports, there's jobs being created, but they're all part-time jobs instead of full-time jobs. Private hours, we see hours decreasing. So we're not creating full-time jobs. The people with jobs are working less hours. And when we look at this here, unemployment rate is clearly rising. The current trend is volatile, but rising unemployment employs the SOM rule could be triggered as early as June of 2024. Another perfect predictor of recessions, as we can see in here. So it's just in looking at it, one of the things, Jeb, that we've heard as a hypothesis, why is the jobs economy so strong, is that we're not losing construction jobs, which is an indicator of a weakening economy and also a big recession sign. But when we look here, we're seeing hours cut. And so builders don't want to let their construction workers go, but they are cutting their hours. And we still have a lot of projects. We had a big stimulus package that was passed. A lot of that goes into construction, not necessarily of houses, but of roads, infrastructure, all of that fun stuff. Last one we want to look here, wage disinflation going down the income stack. So Atlanta Fed wage growth tracker for hourly workers coming down, and for those with a college degree coming down. So people working less, we're not creating full-time jobs, lower growth to their wages. So that's what the Fed is really looking at now. They said today, Powell said in that press conference, that we are not wanting to break the jobs market. We don't need to see a bad employment situation before we cut rates. So really, Jeb, big picture, what did they do today? They gave themselves another 3 months to look at both of these, to see what happens with inflation, what happens with employment, and if we see sort of a turning point where the economy isn't quite as robust or as strong as what people are thinking. You and I looked, Jeb, today, what the Atlanta Fed GDP now tracker is down to about 2.1%. A couple people that I look at are predicting that number to be down near zero by the end of the first quarter. And that was versus 3% in the fourth quarter. So big picture, there's a lot of things that the Fed is looking at. Today, we expected would kind of be a market mover one way or the other. They would come out dovish or hawkish. They kind of threaded the needle and it didn't change much today.
Good stuff. That's not our last chart, I know. So
no, we got a couple more here. That's again more stuff on jobs, but just wanted to show you guys, we all know in the fourth quarter we had this big improvement. This was the 10-year coming down. 10-year has just continued to tick up from there. What does that mean for you if you're in the market for a mortgage? Mortgage News Daily is reporting the 30-year fixed at 7.03, 6.9 essentially for Optimal Blue. FHA rates 6.75 or 6.53 under Mortgage News Daily. So rates still elevated. We're up 0.25% from the best levels in December and January, and it is certainly putting a little bit of a brake on the spring housing market. It's definitely accelerating, but not to the degree that we normally see in the spring, and this is having an impact on it. Unfortunately, nothing that we learn today is really going to tell us what happens in the coming months, and we're just going to sit back over the next 90 days and watch the data.
Yeah, good stuff. So we skipped a couple slides. Are we going back to those? Or are we done?
We just buzz through them real quick. What I wanted to show with that is this was came up from Resi Club. So three data points that point out why not only are home prices sticky to the upside at all times, but especially so in the current market in the U.S. This shows around the world: Finland 95% variable rate, UK 18%, and those are pure variable. The sort of salmon colored line there is a short-term fixed, where the rate is only fixed for 1 to 5 years. In the U.S., 96% of rates are fixed rates. When we look at, Jeb, this was the chart that I was talking about, where you mentioned in the middle week, by week 14 of 2022 is when we crossed 5%. Since then, everyone has gotten a rate above 5%. But prior to that, anyone that bought prior to that point or was in a financial position to be able to refinance has a rate somewhere from 2.5% to 3.5%. So we got fixed rates at really low levels. And then on top of that, Jeb, we got 39% and change of US households have no mortgage. So it doesn't take a genius to figure out why. It's going to take a lot to put downside pressure to prices, no matter how much 8 or 10 people want to show up in the comments and say, it's going to crash. It's going to crash. It's crashing.
Agreed. And we're going to talk about that in more detail, but listen to Jennifer Lego here and hit the thumbs up if you guys find any value at all. If you're listening to us on Spotify or Apple Podcasts, you can rate us, review us. That helps us. And ultimately, helps us accomplish our goals. So if you find any value with this at all, guys, that's all we're asking. We're not asking for money. We're not asking for any of that. We're just asking for engagement, because the engagement actually does help more than you probably know. So, Josh, got a lot of questions, some around the NAR settlement, some just coming in from different places. So let's
do you want to say, Jeb, that any of the NAR stuff, we'll answer them, but try and give a brief answer, because we did do 40 minutes on today, going in far more detail than we can here. So it'll be out Tuesday. Make sure you listen to that in the podcast, but we can give you a quick answer, a quick overview.
Yeah, we'll go through them kind of as they came in. And just a reminder, if you put a question in, just put it in once, guys. We'll do our best to get to it. You don't need to put it in more than once. Willing is asking, if you have a borrower and his spouse is going to give all the funds for closing, borrower is not on the account, is that acceptable?
Okay, there was a secondary follow-up question on this, or the second piece of it. We're asking two different pieces. On Fannie, Freddie, FHA, VA, the borrower doesn't have to have any of their own funds. So this can be a gift. It can come from their spouse. They do not have to have any of their own funds. You just have to put it into your loan application so that the automated underwriting system is picking it up correctly and seeing those are gift funds and not their own funds and accounting for it. But it is acceptable. The second piece there, if the spouse is a realtor on the transaction, does that create a problem? Being an interested party, can the spouse use her commission income to help with closing costs? Not if they don't already have the funds. So a realtor can use the commission towards their closing. They can't, in this situation, it sounds like the realtor spouse is not on the loan. So in that instance, it's going to cause you problems. Your borrower will need to have their own funds. So if the spouse that's giving the gift has enough for the down payment to meet that requirement, the commission can absolutely be credited there to cover the closing costs. But you have to make sure you're not exceeding interested party contributions, because in that instance, they're no longer a spouse. They're the realtor when they're using that commission to credit towards closing costs. So you should be fine, but there's definitely some dicey issues there you got to be aware of.
All right, good stuff. Big G has a question. Can you explain the money trail when I sell my house? For example, suppose I sell my house for $1 million. Where does the money go? Does it go into an FDIC insured escrow account? Yes, it goes into an escrow account that the escrow company manages, and from there it gets wired out. So if you have a loan to pay off, they pay off that loan through, paying those funds. If you had collections or not collections, if you had other debt that was being paid off, for example, well, not so much in a purchase, but in a refinance transaction, that would be the case. They would pay that debt off. The remainder, the balance, essentially goes to you as the homeowner. It can go through wire. It can go through a check. Wire is typically the best way because it comes in immediately. You don't have to worry about, clearing it at your bank and all that good stuff. But it is insured, if you will, by the escrow company. But wire fraud is real, guys. So not so much when the escrow company is wiring money to you per se, but when you are wiring money to the escrow company, just make sure you're doing your due diligence. If you're buying a home, you've got a balance to pay, an escrow deposit to pay. Make sure you call the escrow company and confirm. Don't call the number and all the information that's in the email that they send you. Look it up and make sure you have the right information so that you're not getting scammed. It's very, very important. Big G follows up with a question saying, what do I do with the $1 million from the sale of my house? Do I put it into FDIC insured accounts of $250,000 each? Sure. You can do that. Bonds right now. Some of the stuff's paying 4 to 5%. Crypto. Yeah. I'd lose it all. It's great. Gamble it. No, but yeah, you want to break it up into separate accounts so that you don't have to concern yourself with the possibility of losing it if that were the case.
Jeb, I'm thrilled that Big G has that insight and knowledge because one of the smartest people in my family, self-reported, was bragging recently about having well in excess of $250,000 in a single account at an FDIC insured institution. So sort of betraying that they're not actually the smartest person in the world. So Big G may be. So it is important if you have more than $250,000. Please move it to multiple FDIC insured accounts at different institutions.
And I will touch on your other question in a moment, Big G, but we're going to go here. So Real Estate Curious is asking Jeb, looking for a medium to long range prediction for me. If rates fall to 5 to 6% range this year, it should spur demand and supply, as well as people who have been staying put due to high rates might be swayed to move. If rates decline, it will likely result in more demand and supply. What happens to prices? That and this other question, Josh, I think we answered all at the same time, is Dimitri asking the question if the Fed will make 3 rate cuts, the housing prices will explode. So you and I have come out, in different podcasts and different things and said similar message that we do believe lower rates are going to lead to more buyer demand. At the same time, I believe there's somewhat, not a cap on appreciation, but the days of 10, 12, 20% appreciation year over year is probably limited, in my opinion, just because of the housing affordability piece of the puzzle. We're sitting at some of the lowest levels when it comes to housing affordability. So the idea of home prices increasing substantially across the board I don't think is realistic, just because I think there's less able buyers out there able to push prices higher even with rates moving a little bit lower. Now, 2 to 3% a year, 4 to 5%, that's possible. But I do think prices continue to increase for the next couple of years, just because of the market that we're going to be in with lower inventory, buyer demand. We still got, demographics pushing, prime buying age and those people becoming becoming home buyers during that period of time, which adds just more demand to the market overall. And Josh, you can kind of fill in the blanks here in just a minute, but the idea that the Fed cuts 3 times is going to lead to some massive increase in demand, I don't know that to be the case. And the reason, hear me out. The reason I say that is because the Fed has come out 2 different times and said they're going to lower the Fed funds rate 3 times. That to me leads the market to believe it's already priced in to some degree. Now, what I will say is that the Fed funds rate coming down likely improves the spreads a little bit more on the 10-year and the 30-year, which allows interest rates to come down just with those spreads improving by themselves. But just because the Fed reduces 75 basis points doesn't necessarily mean you're going to see interest rates improve 75 basis points. Part of that, I think, is already accommodated for to some degree. But Josh, you might have a different opinion.
No, if you look back, Jeb, we did when it was the January meeting, and the Fed comes out super hawkish, and we did a live just talking about how they're losing the plot here, that we are getting restrictive, that there is room to cut and still not have an accommodative stance. So accommodative means different things across different portions of the economy. And I guess what I would say, even if it did lead to a 0.75% drop. If we're roughly 7%, we're a hair under 7% right now. If we go down to 6.25%, we saw that for a few weeks in December. Now, granted, that's during the holidays. Most people aren't ready to run out and buy a house, but the market picked up. We saw more applications, but the market didn't go nuts. People can adjust rather quickly. But if you remember, when rates hit 5%, people were like, this is nuts. No one's going to buy at 5%. Now we're saying if they get to 6.25%, everyone's going to come flying out of the woodworks. There will be more activity. There will be more sales. There will be people. Jeb, you made the decision to move when rates were significantly higher. We have another friend who his life stage and family situation is telling him, hey, you have to move. That happens. And there will be more of those people the lower the rates come. But I just, short of a 5%, a 4.5% interest rate, I don't see a situation where demand increases more than supply does. I think the potential for lower interest rates and people wanting to get in the market puts a floor underneath us of how much lower we can go. And then we have a cap above us in terms of affordability. Even at 5.5%, many people cannot afford the prices where they are, because while rates were going up over the last few years, we just saw the number for California statewide, which again, you got to know your actual market, but year over year was 9%. Like if you couldn't afford last year at 6.5%, you can't afford this year at 6.5% when prices are 9% higher. So I just think the path is somewhere in the middle, right? Just 0 to 3 to 5% appreciation. And I said that last year and was a little bit shocked when I looked up to see California was at 9%. But I can say for all of my entry-level buyers in California trying to buy, if they're in Sacramento at $500,000, if they're in Orange County at $900,000, they're having a heck of a time and they're having to get into competitive bidding situations.
No, good stuff. So we do have some questions around the NAR ruling that's affecting buyer commission. So as those of you just tuning in, we recorded an entire episode today, 40 plus minutes of what this really means to you as a buyer, more so than how it impacts me as an agent. It's going to come out Tuesday of next week. It's a good episode. It's worth listening to. We're not going to go over in detail all of these questions here because honestly, we did spend 40 minutes explaining this, and there's more than just headlines that we want to go over. But let's kind of touch on some stuff here just briefly to kind of give you an overview of what we're talking about here. So Big G says, can you explain what the new rules on payment to buyers agents mean for the lane, in a layman terms, if you will. So what happened? NAR ruling over big picture. NAR settled. Part of that settlement says that sellers and can no longer preset buyers agents commissions, if you will. And we're just going to loose terminology here. Second thing is commissions can no longer be posted in the multiple listing service. Those are the two big things that are really, really important there. Because that's how a buyer's agent gets paid. They look into the MLS and they say, Josh wants to see a home. I look in the MLS. I say, okay, I'm getting paid 2.5%. I know what I'm going to make on that deal. The problem with that is transparency. The buyer's agent has no idea essentially what that agent's making. Do they need to know? Depends on who you ask. But what I will say is the idea is that buyer's agents have always gotten a free deal from the transaction that they're not paying for. It's being paid by the seller. Understand, you've always been paying it. You've just been paying it as part of the price. It's just been built in to that price for, whatever the period of time. Now, it's always been negotiable. So the idea of 6% is always the standard's garbage. It hasn't been 6% in our market in a very long time. In fact, even when it was 6%, it was never 6%. Sometimes it was 5%, sometimes it's 4%. In my office, we talked about commissions today. The average is around 4.223, 4.3% average. So that means some are at 6, some are maybe at 3. You just don't know. But anyway, that's big picture. The questions are, how does that impact prices? So Josh, I'm going to leave this to you because we talked about this, but really simply, our prices, NPR, by the way, seems to think that prices are going down as a result. So you tell me, Josh, how prices go down as a result of buyer commission.
Let's start with don't listen to NPR, period. Just end of story. No more listening to NPR. But everything comes back to supply and demand, right? Does this increase supply? Does it decrease demand? The only case that I could possibly see for someone saying this is going to decrease demand is if every seller in the United States says, I will not pay for the buyer's commission, and every buyer cannot pay for their agent's commission. So therefore we have less demand. We're going to have some spectrum of there. Some sellers are going to pay some or all of the commission to the buyer's broker.
Mhm.
Some buyers will be able to pay their own broker. There will be some sort of discount offerings out there where someone says, hey, for $1,000, I'll write up the contract for you. So I don't think it's going to impact demand to the negative side. And I certainly don't see how it's going to increase supply. I don't think anyone's been sitting at home going, hey, I would sell my home if it weren't for also having to pay the buyer's broker commission, which they didn't have to. They didn't have to. They could have just always said no or put out 1% or any number. So I don't think it increases supply. I don't think it decreases demand. And those are the only two mechanisms that affect price. So I don't think it will have any impact on prices.
Well, here's the thing, and something I want important to note here that's very important is that sellers have always been able to opt to go to a discount broker to list their home for less money and or pay the buyer's agent less money. I've been in many conversations with agents where they said, hey, can we reduce this fee? Sure, you can reduce it. But let's talk about what happens when you reduce that fee. What is it? How does it impact you? That conversation isn't going away, guys. It is going to become the norm. That is going to be the conversation going forward. And some sellers are going to choose to continue business as usual, as it always has been. Some are not going to do that. But to answer the question, how do buyer's agents, or how are they going to get paid? They're either going to get paid from you as a buyer, paying them directly. They're going to get paid by the seller paying them directly. They might get paid by some sort of concessions, building it into the price somehow. That's a potential option. Or the third, maybe the seller pays part of it and you as a buyer pay part of it. But here's what's the most important thing that you absolutely need to know. And this is really all that matters, at least over the next couple of months, because for one, this hasn't passed yet. It's not expected to happen until June or July, but you're going to have conversations starting now with any agent you go to buy a home. Commission is going to be a conversation. It's going to be a conversation. So that agent is going to tell you what they charge. It doesn't matter if you go to the listing agent. Doesn't matter if you use your friend. Doesn't matter if you come to me. We're going to have a conversation. The conversation is going to start with these. This is the service I provide. This is what I charge to do it. And if you choose to go with whoever, you're going to have to sign an agreement. That is very, very important. Could it lock you in? It could, if you don't properly read it and make sure the right boxes are checked. In some cases, there's a clause where you can get out of it, but understand you are going to sign it going forward. That is not going away. That is a stipulation of the settlement. Every single buyer has to sign it. Now, understand, it's not supposed to happen until June or July. It's going to happen sooner than that. That said, we're not going to talk anymore about this tonight. Watch the episode, listen to the episode. Yeah.
Bill had a really good follow-up. So my understanding of their position is that the 6% was baked into the price. Now the price will be 6% less. Okay. And we literally talk about this in the episode.
Oh yeah.
I know of no seller in the world that says, hey, my neighbor just sold his house for $500,000. I'm not going to pay the buyer's broker, so that's going to save me 2.5%. I'm going to ask 2.5% less for my house. They're going to go, this is sweet. I get to make 2.5% more. There is literally not a seller in the world going, hey, my cost just went down. I'm going to throw the sign out in the yard for less money. So that's,
I'm just going to, since now I'm no longer paying that commission, I can charge less on my house. No. And here's the thing is, we talk about this in detail, but I want to reiterate it, is that you have no idea as a seller what the listing agent made on that, what they charged on that house. They might have charged 1% and the buyer's agent might have been paid 2.5%. So in the media's eyes, there was a 6% commission there, when in all reality, there might not have been. So this whole idea that everything is 6% baked into a price is garbage. It's not. And that's, again, headline and everything that goes along with it. But honestly, today's episode, listen to it next Tuesday. It's good stuff and it will give you all the information you need. And if that doesn't, then come on here and ask the questions. Josh, we've got a question here. If I put my house on the market for $1.5 million because I got greedy, and then I dropped the price to $250,000. That'd be a hell of a drop, man. That's a $1.25 million drop. Maybe you drop it by $250,000. Is that what you're saying? Does that count in the statistic of a price drop? Yeah, absolutely. Anytime if you have a home that's listed for $500,000 and you drop the price to $499,900, that's $100. Guess what? That's a price reduction. That's a price drop. That counts as in the percentage of homes that have had some sort of price reduction.
And Jeb, you may or may not know the answer to this. That number when we put it up there is a measure of listed homes with a price reduction. So
Correct.
we see clowns will do this. They list the house and next week they drop it $1,000. The next week they drop it $1,000. Next week they drop it $1,000. That's one price cut, correct? It's considered percentage of homes.
That's my understanding.
That's mine as well.
Homes that have had any sort of price cut is and it's not the homes have been reduced by 30%. It's 30% of the homes on the market, say that 500,000, 30% of them have had some sort of price cut is the way to understand it. How do I know if I'm getting a good deal, Josh, on a home if there are limited comps and all those comps are from 21 and 22?
That's an interesting one in that it's got to be a limited supply market, rural area, vacation type area where there's not a lot of homes, because that's not common. So what an appraiser has to do in terms of determining comps to determine if that's an acceptable collateral for the borrower or for the bank to lend to that borrower is they have to go back in time, and then they have to do time adjustments. Mm-hmm. So it gets to be much more inexact. If you have a brand new tract of homes built 3 years ago and there's only 4 models in there of the exact same square footage and similar amenities and upgrades, super easy to appraise. You get in an area where every home is 6 miles apart and some are big farmhouses, some are smaller farmhouses, bigger and smaller acreage, it can get really difficult.
Good stuff. I'm posting this just because they said
I agree.
And I agree with that comment. So we're putting it out there. But thank you for the comment. It comments like that inspire us to continue doing this. So
does her kind comment get her question answered, Jeb? Because she got a question too.
Sure. Yeah. I put it up there.
Jeb, when is the best time to sell? The royal they said to wait after the election because prices are about to go down before the election.
So why would you wait till the election to sell if prices are going down? Or they said to wait after the election because prices is so. If,
Jeb, we actually
they're going down before the election.
Yeah.
The best time to sell is when it's the right time in your life. That's the easy answer. Second best answer is when there's low supply of homes and there's enough buyer demand to essentially get the price that you feel like your home is worth. In my market, I would tell you if you were looking to sell, now is the best time without knowing exactly where rates are going, because there could be some demand pickup in the second half of the year. But Josh and I have been over the charts. We've shown it actually in an episode. The majority of appreciation in any given year is between the months of like April and July. And guess what? If that home's closing in July, guess when it went under contract? Probably went under contract in May, because it went under contract in May, closes in June or July, right? So a couple months prior is the best time to put it on the market. You're heading into April now. You're getting right prime season. I would say put your home on the market if you're looking to get the best price this year. But that's not always true, right? We've had a couple of really weird years where we've had demand in the second part of the year when normally that's a slower time of the market. So what I do think is going to happen is as rates come down, you're going to have a little bit more buyer demand. Now, does that mean it's a better time to sell in the second half of the year? It's, I don't know. I don't know. I just know what I know right now. And what I know right now is that if you are a seller, it's a good time to take advantage of it. So just, talk to a local in your market. Real estate's local. Some markets aren't experiencing what we are here in Southern California. They're a little bit slower. So you've got to think about that as well.
And if you're in the Northeast, it may be even hotter.
Yeah, exactly. We talked about them last week. This one, Josh, we answer a lot, but we're going to answer it again. Not even going to try the name. At what point does a refi make sense? How do you calculate it when it makes sense? Is it ever worth chasing the rates down or just waiting some time to avoid multiple refi fees? I'm in no rush.
We have answered this question a lot, but this is a different angle on it. I like it. And I'm going to try it, Jeb. I think it's Jortholomew. That's how I'm going to pronounce it.
I like it.
So, simple answer. We do have a rule of thumb for this. Take $125,000, divide it by your loan amount, tells you how much you need to drop for it to make sense for a lower no-cost refinance. So $125,000, you have a $500,000 loan, that's 0.25%. You have to save 0.25%. If it's $1 million loan, it's only 0.125%. On the flip side, if you have a $125,000 loan, it has to drop a full 1%. So the second part of that question, does it make sense chasing the rates down? It can, but I would be very careful. Here's the debate. So when someone, I've had several people here who've had an opportunity that have a 7 3/8, a 7 3/4, and we can get them to 7%. And at their loan amount, it makes sense. I say, we can get you 6.875, but at 7%, we can do a no cost loan. I say, let's do the no cost. That way we make sure we don't get stuck at 7 3/8 or 7.5. We get down to 7, we're not adding anything into your loan. But if rates go to 6.5, 6 5/8, we can do it again, no cost. So you're leaving some of the potential long-term savings on the table, but you're not adding costs into your loan so that you can benefit if and when they move lower. We believe they're going to move lower. I do not have a guarantee on that. So you have to just take into account, if you knew for a fact that you're at 7 3/8 and we said in 18 months rates are going to go down to 6% or 5.875, you would probably be better off just waiting. But we don't have that guarantee. So especially for larger loans, $4, $5, $6, $7, $800,000, I'd be looking at every opportunity to roll it down with a no-cost refinance that you have. I'm not saying at the minimum that 0.25% savings, but if you get 3/8 or 0.5% and you have a $500,000 loan, you can do it at no cost. Probably makes sense unless you are on 100% confident that we're going to be going lower in the near future, next 1 to 2 years.
Good stuff. Just Josh, I was drinking out of my water bottle, which is a Yeti. Yeti, if you want to sponsor the show, we're happy to use your products and drink out of them. But I have a Melon sticker on it. Melon's here local to Southern California. If they would like to provide us hats, we will wear those on the show too. Hey,
True.
I know people that know him. Just reach out. Just give us free hats. We'll wear them. Anyway, that's all.
We'll wear them and plug them. We'll talk about them for a minute every week until people tell us to shut up about it.
Well, even if they do, we'll still talk about them. So make the connection, guys. Would love to make it happen. Anyway, on to the reason why you guys are here. Somebody or bankroll TJ, dude, it's you.
I need him. I need him in my life. Yeah. I need some of that bankroll.
What do you think of lease to own? Inventory extremely tight in my area. Lease to own is a good option. In the current environment, if the numbers make sense. Understand how lease to own works. Most people don't. Typically speaking, you're going to pay more for your rent on that house than you're currently paying. Say, for example, you pay $3,500 a month to rent a similar house. To rent a lease to own, you might be paying $5,000-$6,000 a month to rent that house, but $3,000 or whatever the number you guys decide is going towards the down payment to actually buy that home at whatever point you guys decide. Now, here's how it works. You decide not to buy that home. In most cases, you don't get that money that you put down as part of that agreement back. So there's a lot that goes into it, a lot more than we can discuss right here. Lease to own are great deals if you can't qualify now for whatever reason. Maybe you're a new business owner, your income situation is going to change in the future. Maybe rates are just too high and you're thinking of waiting for a better opportunity. Those are good times to take advantage of it.
We've said this before, or I have said this before on the show, Jeb, so feel free to disagree. You kind of already did. They're a great deal for the seller. Basically what you're saying is I will buy this property if I can make my rent at an above market rate, and they'll apply the portion above it to my purchase. But I have to buy this property. I got to agree to do it now. I do have to put a roof over my head, but I'm going to pay extra for it as an option to maybe buy this in the future. But it almost never works out. And what it does is the owner got an above market rent and they don't have to give your option money back.
Well, let's look at it devil's advocate. You get today's price, if it's a price you agree with, when we think over the next 2 to 3 years, home prices are going higher. So if your option is to lock in a price a property that you like, now you're not just getting suckered into a property that you're leasing and like, oh, I guess I'll buy it. Oh, whatever. It's like the house you want, everything else makes sense. You're able to fix today's price, then I don't see anything wrong with it. But I mean, I see your point too, if it doesn't work out.
Let me ask you. So I like this fun debate portion of the show. You are not wrong. I still would lean towards my direction. Have you ever heard or seen a successful lease option sale?
I have not.
Exactly. So enough said. I do know investors that own homes that this is what they do. It's been a rental. They've had it for the last 20 years as a rental, but they've had 7 different option lease to own buyers in it over that 20 years.
The only thing I would argue to say is I'm in the business of selling homes. I'm not in the business of dealing with lease to option. So I don't really come across them. So that's part of the
Well,
reason
hey,
I don't see them. But yes,
you got someone voting for you in the debate here. Esau says
no,
lease to own worked for us, locked in 2018. So it does work. There are people out there that are successful for. What Jeb is saying is not wrong. I would just go in eyes wide open and think of every potential thing that could go wrong, because they go wrong more often than they go right.
there you go. Let's see. Nick has a question. Says, been on the hunt for a while. Nearly every single family home we look at is $100,000 more than it was back in 2019. Do you think these new values are here to stay, or they'll come back down? So, I mean, the easy answer for me, Nick, is you're not going to see 2019 prices again in most markets, right? We're in Southern California. I don't think you'll see 2019 prices ever again. Now, if you're in a market that has a lot of inventory and things are just not selling and prices are having to be reduced, maybe, but I don't think that's most markets. Josh, anything on that?
I want the comment section on this to just go wild with the people who tell us every other week that this data, that data, this factor, it's coming. So many of these people are in California. Just in the last year, we're up 9%. So since we had the turn in 2022 when rates spike, we're up about 13, 14%. Like, you need 20% to get back to the end of COVID. We're getting to the point where it's absurd. The people that have been telling you, wait, it's going to crash. I'm a vulture. I'm sitting over here counting my money. I'm going to jump in. I'm going to buy 2 for the price of 1 when this thing crashes. At some point, you got to go, oh shit, I misread this so bad that it's never going to happen. And some of those people tell us, well, I qualify. It doesn't matter if prices go up another $200. I still qualify. At some point, you're going to have to just swallow your pride and step in where the market is. And again, for those of you who are, I'm not happy about it. I don't care. I would rather have prices 20% lower, because then I would have 100% more qualified buyers. I would be doing smaller transactions, but twice as many of them. So when you look at it, I would like that. It would be good for buyers. It would be good for the economy, because home selling, homes changing hands, higher volume trickles all the way through the economy, whether it's Home Depot, Lowe's, furniture places, tile places, flooring, all that stuff. It is much better all the way around for everyone for prices to be lower. Again, it's supply and demand. The numbers don't add up.
But with what Josh said, I do agree with what Josh said, but understand prices can't continue what they've been doing forever like this, right? At some point, you've got to have some sort of moderation. Is it flat for 5 years, 10 years? Is it down at some point? Maybe, but the only way that happens is if supply exceeds demand in a meaningful way, and we're not there yet. We're not even close to that.
And absent, like, we talk about a recession, are we gonna get a recession? You need like monster recession to cause any type of change to that supply. Everyone keeps saying they want it both ways. Like, the economy's great, but then it's bad and it's going to shake out this way. Like, we would need a spectacularly bad economy to get any meaningful correction. And by meaningful, we're probably talking 20% would be huge. And we just said, for us in California, for those people in the Northeast, many of these markets in that time frame are up 14, 15%. And you may say, hey, I don't care about that. I'm in Austin, I'm in Seattle, and we're down 8 or 10%. Okay, that's totally true and valid. But in general, across the market, we don't have a recipe for additional supply, no matter how much we want it. And we're not the only ones saying this. And people say, well, you guys are in the business. I'm in the business. I'm telling you, it would be better for me and my income and my household if home prices were 25% lower. It would be better. So, like, I don't know what more to say to anyone other than it would be much better to have lower prices.
I know what to say. If you want to get in touch with Josh or I and work with us directly, there's a link scroll on the bottom. Josh can do your mortgage. I can help you buy or sell a house here in Orange County. And if I can't, I can refer you to somebody that can. So use that referral link if we can help you out. Like and subscribe to the channel if you haven't done so. And that's what we'll say. I put this question up a moment ago, Josh, and it says, how do you beat cash buyers if they are paying more than 5% over asking? Everyone wants a smooth transaction. So I would normally say, what cash buyers paying more than 5% over asking when they don't have to? Here's what I'll tell you is that I just listed a property here in Huntington Beach at $1.575 million. And out of the 5 offers we received on that property, 4 of them were cash. Now, one was contingent on selling another house, but it was a cash offer once that transaction took place. We ended up $75,000 above our price, that Josh, that is 5% higher. So how do you compete with that? You can't. I mean, it's if that's what you're up against, unfortunately, I'm not going to say you can't. I'm just going to say it's going to be very difficult.
Well, Jeb, where could you win? What are the stories that we've heard? We've heard someone that raised their family in this house and they want a young family to get a chance, and they'll give you a shot and say, hey, if you'll match cash buyers 5% over ask, I'm not going to take a discount to put you in the house, but I would definitely rather see you, even though you need financing, than that cash buyer. And kind of, Jeb, just circling back to that situation, we tell these stories all the time. Number one, it's anecdotal. It is specific to our market or the markets where I do loans around the country where Jeb sells. And it is not to say, isn't this great? It's crazy. Like, our jaws drop on a regular basis that you're like, this has to level off. This has to be more calm. So we know that it is frustrating for you as buyers. I have frustrated buyers that have been
It's frustrating for me as an agent. Like, I'm supposed to guide you through the process. And just think of when my commission is on the line. When you're now paying me a commission to represent you as a buyer, and you're expecting your offer to get accepted, and we're going up against this, and people are doing dumb shit that I wouldn't say dumb. People are doing things that are, I wouldn't say, I can't say unnecessary either, because in some cases it is necessary. People are doing things that I wouldn't recommend buyers do. And that's difficult to compete. It's just, it makes it very, very difficult. And so what changes that? More supply changes that. I would love twice, 3, 4, 5 times as many homes as we have on our market right now. I would have a lot more money in my pocket because I would have buyers buying homes versus writing offers and not doing that. So to sit here and think that this is what we want is could be further from the truth. But we got a couple questions, Josh, that come along selling properties. Maddie is asking, if I sell an investment property to put that capital into my primary, that's not going to be considered a 1031, is it? And the answer is no. You have to, for a 1031, it has to go from an investment property of like kind to this, well, of a property to a like kind investment property. So residential to residential, that sort of thing, typically speaking. But it has to go from investment to investment. That's how you avoid capital. That's how you avoid the capital gains on a 1031. Otherwise, you're going to pay something on that gain because you haven't been in that home as your primary 2 of the last 5 years. So hopefully that helps for you, Matt. I know you've talked to Josh a little bit as well. So if you have additional questions, reach out to him. Smart Fox says, if I sell my house, do I need to put a sign outside for my realtor? What happens if I don't want neighbors going inside my house? So there's 2 different things to talk about here. One, do you have to put a sign outside? The answer is absolutely not. I've sold several houses where there's no sign outside because seller didn't want it for one reason or another. They were going through a divorce. They didn't want questions to be asked, whatever. I'll play devil's advocate. A lot of times that sign outside your yard could, the reticular activator is when you see the red car that you're thinking about buying, and now you see the red car everywhere. A lot of people aren't paying attention to homes being sold in a neighborhood unless they see something that makes them think of a home being sold, a for sale sign, for example. So they might know somebody that's looking to move to your neighborhood. So in theory, it could potentially help you in some ways if that person told somebody else that that home was on the market. Now, with everything out there right now with, the web and, different websites, homes are pretty much populated everywhere. So as long as it's in the MLS, you're probably okay and don't have to necessarily worry about a sign. But in some cases, it does help. It does help agents find the right house. I'll tell you that. I've knocked on the wrong house before because I thought I was at the house and there was no sign. But anyway,
did the owner come to the door with a shotgun and ask you what you were there for?
I realized quickly, I don't think this is the right house. But the second part, I don't want neighbors going inside my house. Then just make it schedule appointments only. It keeps the neighbors out. I do several properties where we don't do open houses because we know it's a lot of looky-loos, a lot of neighbors coming through, a lot of people that aren't serious buyers. The serious buyers will schedule time to see your home if they really want to see it. It's really simple. That's how you weed out the people that want it versus the ones that don't.
And with that advice, Jeb, remember, it comes down to, are you in a strong buyer's market or are you in a seller's market?
Yep.
A lot of markets, especially here in Southern California, it's a seller's market. Seller gets to set the terms. You may sound crazy to the buyer, but it doesn't matter. If they want the property, they'll do what you want. If you're in a softer market, you may have to think about that.
All right. This is a good question, Josh. We didn't talk about this in our breakdown, but Billy's asking the question: do lenders make less money using a Cal FHA conventional? I ask my lender to give me an estimate, and his rates were 2 points higher, even though I asked for Cal FHA conventional. So basically, he's asking: do different types of programs warrant higher rates for these types of programs?
Cal HFA sets the rate. You call me, you call 50 other lenders, you're going to get the same interest rate. Do we make less on them? Generally, yes, because the reason for that is on a typical loan, we're going to get paid by the lender. So if we're a broker, the lender can pay us at closing. If we're a direct lender, we're going to sell that loan and make money when the loan is sold because there's a value to it in the secondary market at any given interest rate. Cal HFA doesn't have that. The loan's going to them. They don't pay us. So it ends up a borrower paid transaction. You're going to pay it, and they offer one interest rate based on the terms of the loan. There are a couple things that will vary there. Down payment, no down payment. Dream for All is going to have one interest rate for people who meet the income requirement, one slightly lower interest rate for people at or below 80% of the area median income. The one here that I will say, Jeb, you talked about using the link below, reaching out, working with us. I get questions from people all the time like this, where they talk to a lender and they get answers that just don't make sense, answers that are crazy. Had one this last week where someone said the lender told them they couldn't give them numbers because they don't have a property yet. This is going to be about 6 3/4. And I knew the lender. I know they're one of the highest priced direct lenders in the market. And I go, there's no world in which at 0 points, they're at 6 3/4 today. They're not giving you numbers because they don't want you to be able to compare. I can give you numbers, and you and I have to have a conversation and realize these are good for today. You can't lock them because you don't have a property. But in a situation like this, if you're talking to a lender, like I would just say, I asked my lender. Let's not apply my lender. You asked a lender that you're talking to, and the person that's going to become my lender, your lender, is the one that gives you a comfort level. There's 3 pieces to this. Do they have competitive terms? Do they have knowledge and expertise? But then do you connect with them where you feel like open, honest dialogue? You can ask your questions. They don't make you feel dumb, and they give you good answers to it. So I'll stop preaching.
No, good stuff. A couple good questions here. Let's see. HX says, do you think lenders will factor in buyer's agent's commission fee into the loan? I don't know. I do think at some point things will probably have to change a little bit, but I don't know if, again, it takes more. You got to alter Dodd-Frank or revise Dodd-Frank, and that's not going to be an easy task, at least in my opinion. But I do think at some point there will be an option there. It's my guess, but it could be years away. Josh, any thoughts on it?
No, and that's why we say, overall, I think this change 5 years from now, we will look back and say this is a positive. This is better for everyone involved, much more transparent. In the short run, there's lots of things like this that have to get worked out, and they won't get worked out immediately. It's going to be 6 months, 12 months, 24 months before we get through there. How do we see what's the most common way for this to happen? Is there a most common way? Do most sellers continue to offer to compensate the buyer's agent? Do most say no? Do lenders have the ability to absorb it? Because who are we really talking about here? Most of you guys are first-time buyers. We have a lot of move-up buyers in the audience, but the majority of the audience, 50, 60% is first-time buyers. First-time buyers scraping up enough money for their down payment and closing costs. Now we're going to say, hey, you need another 2.5% there on top of it. That's going to be problematic for first-time buyers. Now, if I'm a move-up buyer, I sell my house and I got 300 grand in my pocket, I can pay my agent and it doesn't impact my transaction at all. We are talking about first-time buyers and people that have not built up significant equity in a property.
Good stuff. You guys should be more like Mina. Mina gives us $5.
Mina's the greatest.
Mina gives us $5 every single week. So for that, Mina, we are thankful.
When we have the live show, Jeb, Mina is going to have a throne that she sits on, and everyone has to realize that Mina is top of the food chain. The rest of you guys get in where you fit in.
There you go. Big G, another question. It's been the Big G show, but but good question here. It says, have you guys heard about this? If I live in California and I'm over 55, you can sell your home, take your previous home tax assessment with you. This allow you to move up into a more expensive home. The answer is yes. It's called Prop 19, but there's some things to understand about it. You have to, when you buy, say, a home of equal value, if you will, say you sell a $500,000 home, you buy a $500,000 home, your tax basis basically transfers. Yes. But if you sell a $500,000 home and you buy $1 million home, you're only taking the tax basis for that $500,000. The additional $500,000 gap there, you're paying a stepped up basis on that $500,000. So whatever the current taxes are based on that difference. So understand it. We've talked about it before, but hopefully that gives you a little bit more clarity on that. That's just California, guys, not anywhere else. There was another good question here, Josh. What incentive?
Jeb, let me throw this one out here. Garrett is not here. He's closing about 4 to 6 months. Thoughts on which option? He asked a question earlier. Then he said had terrible service. He was going to come back and watch this later. Garrett, we are not ignoring you. I'm not sure I understand your question. Email Jeb and I at info@theeducatedhomebuyer.com and we will get back to you. I'm just not sure I understand the details of your question.
Yeah, I read the question too about selling a home and then taking some of the equity and doing a recast.
I just wasn't clear on what you wanted to do. So send us a detailed email and one of us will get back to you, or both of us might get back to you.
Yeah, there you go. Good stuff. So been on an hour now, guys. If you haven't done so already, hit the thumbs up. Like the episode. It does help out the algorithm. If you're not subscribed to my channel, I would appreciate that you do it. If you haven't seen the Educated Home Buyer podcast, that's our podcast style of the show. Go into a deep dive on episodes, talk in detail. Head over there, like and subscribe, listen to us, rate us, review us if you're listening online. That stuff helps. This episode actually goes on the podcast every Friday. So if you like to listen to audio, you don't have YouTube, what's the upgraded version? I have it, but I don't even know what it's called. YouTube Premium, where you have to deal with commercials all the time. Just go to the podcast, man. Listen to it the whole way through. No commercials. Easy peasy, baby. But anyway, we're going to answer a couple more questions while we're here. If Josh has a minute. Josh, what do you see that looks quick and interesting?
Here's one here. Torio says, what incentives does a seller have to do seller financing? It has to be of a benefit to them. Right. They don't have a need for their cash right away. They don't know what they're going to do with it. So they would like to get a return on that money. If say rates are at 7%, even with elevated returns in the bank, you're going to cap out somewhere around 5%, and there's no guarantee on that. You could get 7% there. There can be some tax deferral situations there. So really, there's not a whole lot of huge advantages. Like Jeb said, most people, I would rather have my money and take off and go with it. That being said, I have a client looking to buy an $8.6 million property down in San Diego, and the seller is willing to carry back 25% because it's a unique property and it's going to be real hard to finance. So they have $5 million of equity built up in that property, and they're willing to leave a chunk there to be able to accommodate the sale and pull a sum of that money out in the form of the sale.
Those are real world problems right there.
Yeah, they are. Yeah. Those are first world problems.
It's all good though. It's all good. Let's see. Big G, another question here. Geez, if I sell my primary home and buy another primary home of greater or equal value, do I still have to pay taxes on the gain over $500,000, or do I avoid that capital gain tax by purchasing my next property? The answer is no. You do not avoid the capital gains tax. The way that the law used to read, or the exemption used to read, is that if you took your gains, all of your gains, and put them into the next property, there was no consequences. That changed when the 250-500 came out. So now
27 years ago, Jeb, but we still get the questions about 1997, 27
is that what
years.
It was? Yeah, so 250 and 500. But understand there are things that you can deduct out of that will lower that basis that you're actually paying taxes on. Improvements, commissions, there's a number of things that you can factor in there. But you buying another home doesn't exempt you from that. Last one, Josh. We'll talk about this. Why are buyers getting screwed on this lawsuit? I have to now pay $20,000 to the buyer's agent. This will impact sales. You don't have to pay the buyer's agent anything. That's the best part, Kathleen. You get to decide. It's a free market, what you're willing to pay someone. It's up to you what you agree on. Now, the buyer's compensation might be, hey, this is my fee. This is what I expect to get paid. And you can say, great, I agree with you. Or, no, I'm going to go find somebody else and negotiate, or you can negotiate with them. But understand, you don't necessarily have to pay it. That's one option. The other option is maybe the seller does pay it. The other option is maybe it gets split between the two. That's the beauty of a free market. It sucks in the short term because there's going to be a lot of people adjusting, including myself, with this whole thing. But understand, it's It is going to make it expensive, more expensive for some buyers, without question. But commission pressures are going to get squeezed a little bit, and it's going to be less expensive over time for people to buy homes and sell homes. It's just going to take a little bit of time to do it. But with that, Josh, again, we talked about it on our podcast we filmed today, recorded today. It goes live next Tuesday. Pay attention to it, listen to it. It's really, really good stuff, and it'll give you everything you need to know to buy right, borrow smart, and build wealth. If you haven't done so already, like and subscribe. See you next week. Adios.
Amigos.